The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, welcome to the Diagnostic Trading Hour here with Darrell Martin on TFNN. And make sure if you want to go ahead and call in, you can call in right now with any questions that you may have. You can reach us at 1-877-927-6648. Or international, you can go ahead and call in at 727-445-1044. And I'm here to answer any questions you have about the market in general, any specific, equities or futures or forex that you want to look at, and of course, Nadex products. If you haven't already got a Nadex account, we like to talk about that and show you that it's really a great way to trade. And it's a new era. The market's obviously different, has been for the last several years, and it just keeps changing. And there's so much constantly going on, and you got to ask yourself, if you're trading futures and forex with this dynamic changing market, should you be looking at maybe there's a different market. Should you be looking at a different way to trade it? Or at least a way to maybe merge your trades together? And we're going to talk today about how to merge your trades together. Meaning, I'm going to show you how to hedge Forex and futures, and possibly even ETFs, if you want to, how to hedge your trades. And there's some very cool ways that you can do this. And this is one of my actually favorite investing strategies. Your risk is extremely low. And it allows you to trade how you trade now. But it will, again, lower your risk and give you massive stop losses. We're really talking about stop losses for pennies on the dollar. And we're going to go through and we're actually going to look at a few different products on Nadex and how you can combine those with futures markets, Forex markets, and ETF markets. So as questions come up, go ahead and call in and feel free to ask. If you haven't got one, like I said, you're really going to want a demo account so you can try this out. You don't even have to try it out right away. Just literally place a trade, hedge it, and see how it works out for you. Okay? And but go over to TFN.com, and then over here on the right side, you ought to see there'll be a Nadex banner, usually right here. But go ahead and just click on the Nadex banner. Let's see here if it's not. Let me refresh the page. And go to Nadex.com, and what you do is you go to Nadex.com right here. And then you'll click on, there we go, that's why. All right, let me pull up a different browser. So, gotta love it when your browsers have their own little issues, right? There you go. Nadex banner right there. Click on Nadex, and then click on Create Account. Scroll down. You can open an account. It's only $100 to open an account. It's the amount. It's the fund. Okay, so you're depositing $100 into your trading account. You can start trading with as little as $100, and then you can also open a demo account. You get a free 2-week trial here. Click on this. Click on Open a Demo Account. Costs nothing to open it. You get access to the platform. You get live charts of all the spreads and binaries that are on there. We're going to be focused on the spreads today more. We'll probably talk about binaries a little bit, but more just talking about the hedge strategy. And you go in and just, what username do you want to use? Just put demo dash in front of it, so you'll actually use that. You can even use this on their mobile platform. They have an app on the iPhone, they have an app on Android phones, and they have an app for the Windows phones. So just go ahead and put in your username, first name, last name, phone number, email address, hit apply for demo. They're going to send you a password in your email within like a minute or less, and you'll be able to log in. Tip for you, a lot of times they put a 0 in there. A lot of people don't know if it's an O or a 0. It's definitely an O. So go ahead and just use that. You go here, click login, and you'll enter your username and password right there. And again, click login on that, and you'll be able to log in right away. So if you do that, what I'll do, let me go ahead and log into my demo account over here so I can show you what it looks like. Click login, bring it back up. And now that you're in here, you can, they'll put important notices out. These are really important right here. And they'll say natural gas future symbol rollover. And they're saying we are changing the underlying symbol for all natural gas contracts on Nadex effective Monday, July 23rd. Okay? That the natural gas contracts are going to be based on the September 2012 futures. So that's going to be NGU2. So if you're looking at an underlying market future, or if you're trying to do the hedge strategy for natural gas, effective the 23rd, yesterday, you need to be using the September contract to make sure it's closely mirrored, because futures contracts can definitely vary quite a bit sometimes, and you don't want to be using the wrong contract if you're trying to do the hedge strategy. Okay, so if I want to go in and say buy natural gas and sell the underlying, if I want to buy natural gas, the underlying market being natural gas, and then I want to say sell the spreads, I want to make sure I'm using the right contract. Otherwise, I'm not really going to be effectively hedging myself. Okay? So once you've read that and you understand that, then click Save and Continue, and you can click Don't Show Again, or if you want to say, well, maybe I want to leave that message up there, I just click Save and Continue. It'll pop up next time I log in, and that's just a very, very important tip. And let's see here. There's a lot of information on here that you can take advantage of depending upon what market you want to look at. And so what we're going to do is we're going to look at a few different markets. And, there's a lot going on today. I'm sure, if you've been listening at all to TFN today, then you've definitely heard about quite a few of the big moves that have been happening. And a lot of that's due to, of course, what's going on over in Greece and also in Spain and in Germany. Sort of the three big things going on. Moody's basically put Germany on a negative downgrade watch, saying that the European economies are going to basically undermine the German market, and therefore will raise their interest rates. And so they're already putting them on it. And I mean, they're responsible. They've done very well. They have one of the lowest unemployment numbers they've had in years, and they're even being threatened by all this. And the uncertainty on the ECB bailout, and putting the monetary fund together, because right now the Supreme Court in Germany is going to be ruling in September on whether or not it is constitutional for Germany to take on the other country's bad management of their debt. So should the German people, when they've been responsible and done so well, have to take that on? The answer really is no. At the same time, what kind of instability does that mean for them? And then, of course, we have the September 14th deadline of what's going to happen with the U.S. debt, and the whole thing of raising the debt limit, the debt ceiling, and the tax increases, and the automatic or the tax expiration, which will lead to tax increases. And of course, if they don't pass, go ahead and approve those tax increases, what's going to happen is a lot of the funds that have any kind of profits for the year, they even if they have any kind of profit, they've been holding stuff for a long period of time, then they obviously, you would want to sell before that goes into place. You don't want to pay another 10, 15%, whatever it goes up to. You don't want to pay that additional tax. So you'd be better off taking your profit now. And so at the end of the year, it's probably going to lead to a lot of sell-off if they don't get that approved, because the uncertainty, you'd rather take the profit at the lower tax rate. So that could be a big impact. And so there's just a lot coming up. And, let's see, I think Greece, they have a huge payment, $3 billion coming up here, and they don't here in the next couple of weeks. I want to say it's August 11th. And they have $3 billion due, and nobody really knows how they're going to pay it. And they said, well, one way they could pay it is they could sell off a lot of private assets. But what's really interesting is the chief of the organization that's responsible for liquidating government assets into private property actually resigned, because he says the government is blocking the sale of the private assets. So that doesn't look real promising for Greece. And so what's going on right now is the Troika actually is going over there. And if you don't know what the Troika is, that's basically, it's a group of three people. One represents the IMF, and another one represents the the European Central Bank, and the other one represents the ECB. So you got the bank, the IMF, and the union. And all three of those represented, they're going over there to basically check out exactly what's going on, and if they're keeping up with it, which they know they're not, and what they're going to do to get it back on track in order to keep getting their payments. And the European Central Bank has said they actually are now they are no longer accepting Greek government bonds as a form of collateral until after the Troika does their review, because they're basically concerned that there's a high possibility. I think they are going to be exiting the euro. And I think that the euro dollar, and I mean, this sounds outlandish, but got to make calls one way or the other. I think the euro dollar could easily be very close to par if that does happen by the end of the year. So we'll see. We'll see if I'm right, if I'm wrong, whatever. I wouldn't just place all in going short on it, but that's sort of my call there. We'll see how it works out. They may all come through, but if you have Germany Supreme Court say not constitutional, you have Greece not pass, and then Spain can't get bailed out because the whole thing doesn't come together. And Spain, they just actually hit an all-time high 7.65% on their 10-year bonds. You put all that together, that's not going to make for a strong euro. And then you add in everything else with it. But it just keeps adding up and getting worse and worse. It's not getting better and better. And they've actually estimated now that the total bailout money needed for Greece is going to be $50 billion total. So they're looking at $1 and $2 and $3 billion payments here and there. But the analysts that put it together said about $50 billion that's going to be needed to actually get Greece where it needs to be. And they are literally in the equivalent of a Great Depression at this moment. So there's a lot of things out there, and so you got to protect yourself. You got to figure out what you're going to do with your positions, and just be I guess mindful of the things going on around you in the market. And those are the fundamental factors. Those are not factors you're going to necessarily place your orders on, but there are things that people will place their orders on them. They will be selling because of that. And we talked, yesterday, the last couple of days, we talked about using standard deviation that includes implied volatility in the formula, not the ATR standard deviation. In my opinion, that's basically useless. Okay, if you want to know what an expected move is, you got to do a standard deviation with implied volatility. And go back and you can listen to the archives. And I know we put those up. We try to put those up almost, I think, every day. But yesterday I went into more detail about it. The day before I went into detail on that. You can check out what I was talking about on standard deviation and expected moves. And but today let's go ahead and let's look at what if you want to hedge your position. And you want to go in, and we all think we're hopefully going to be right. That's why we're placing money on there. But wouldn't it be nice to place a trade and not have to pay, not have to worry about getting stopped out just a few points away, but only take a few points risk on the trade, but still have unlimited, or uncapped upside, or in the sense of profit. So whether the market's going to go up, market's going to go down. And some people, when they see the spreads, they're like, well, there is a limit on what I can make. If I go in and I buy a spread and it's near the floor or the ceiling, that's great because it maximizes my profit potential. At the same time, there's only so much I can make on that. And so if we go over here and let's say we just look at a chart, say, we'll pull up ES right now. And so if we're looking at the S&P 500 and it's at 1330. And let's see, earlier this morning, we'll zoom in on the day. We had the market right here, right around the open. And that would have been a sell point on the way I trade there. And market had been opening 1345. That would have just triggered right there. So then we're going to look for one that's going to be pretty close to that and check out the different contract, that were available. And so if we just looked at, let's look at this one as well. Yeah, probably would have chosen this contract, would have more time and more profit potential. And people look at it and they're like, well, I can only make money down to 1300. Well, that would have been a good profit potential. But what if we can open that up and make it where, let's just say the market crashed, you could enjoy the ride but have protection. When we come back, we're going to pull that. We're actually going to start putting together the hedge trade for you on ES, and then we'll go through a couple other products as well. All right, we'll see you on the other side.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit tfnn.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, David White, Larry Pesavento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows. Plus, see all the charts as they happen live during those shows and have access to archives of those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, welcome back to the Diagnostic Trading Hour here with Darrell Martin. All right, so what we're going to do is we're going to check out ES, and we're going to look down here at the 5-minute bars and just go, what's possible with the trades, and how can you hedge your position. So if you're looking to trade the futures market, or you are a futures trader, and this is more probably if you are a futures trader. If you're new to trading the futures market, I recommend that you definitely start with demo trading on Nadex, seeing if you like that. If you like that, you could then of course move into a live account. It's a lot easier to trade. You don't have to worry about what is every tick worth and all that, because whenever you're trading on futures, every market has their own tick value, and one market ticks in 0.1, and that's worth $10. Another market ticks in 0.25, and that's worth $12.50. Another market ticks in 0.01, and every tick is worth $10. And so it can get sort of confusing not knowing which ones, and you do learn it over time, you put it all together. But on Nadex, every tick, which is a tick, if you're new to trading, a tick is the smallest increment an instrument can move in, such as a tick on a stock is a penny, right? 0.01, and so the tick is worth 1 cent. And so futures are leveraged, so it's worth more than that amount. And the way they're leveraged is they actually multiply times the actual value. But without going into a whole lesson, and if you have questions about that, feel free to call in. I'll help you see how all that works. But right here, what we want to do is go in. If you want to hedge your trades, so if you want to hedge stock trades like the spiders. And this works best. The underlying market is going to, of course, be ES. It'll work best at ES, but you could use it if you wanted to apply it on, say, the spiders. Now, one of the questions I do get is somebody wants to take this and they want to move it over and they want to look at something like, the spiders, because, maybe they're not futures traders and they're trying to figure it out. And you'd have to use a lot more shares, but, I'll show you how to back that number down too. Is if we go in and we pull up the spiders, okay, and let me unlink these here. And unlink that one. All right. So pull that back up on the S&P. And, the spiders are going to, be trading a little bit differently. There's, because they're now, they're an ETF. They have different ETF fees built in. The ES is a future, so it's looking forward at the futures market. So it's a future expectation of price. And so what you're going to want to do is you're going to actually, if you want to look at the ETFs, you need to understand what the difference is between the price. Of course, also understand that, when they stop trading and stuff like that. But just putting it all together, if we do /ES, okay, and since this is 1/10 of the size, okay, 133.51, 1328, a tenth of the size, not a tenth of the value, but a tenth of the size, then we can do, minus, and we'll do SPY times 10. And what that'll do is it'll give us a chart, and what kind of chart you want to look at on this, because this is just basically noise, bid-ask spread, things like that. We want to get rid of all that. And so what I'll do is I'll go ahead and zoom in on this chart for you. And basically this is showing you what's called a spread chart. And the kind of chart you want to look at on a spread chart is going to be a line chart. And the reason is because on a spread chart what they're doing is they're looking at the high, and actually they're minusing like the high from the high, the low from the low, the open from the open, the close from the close. Well, that sounds good, except for the high on ES at 1 sec can be different from the high on the SPY during that minute. So they're looking at the high of the minute on the ES and the high of the minute on SPY. If they're looking at a daily chart, they're looking at the high of ES on a daily chart and the high on the spiders of a daily chart. And they're minusing those. So the high and the low are not going to be accurate because the highs obviously could be at different times of day. But so just be aware of that. And if you're going down to minute charts or 5-minute charts or whatever, then at least it's the close of the 5 minutes, which should, obviously is going to be the same time. And so we can look at this right here, and I'll even take off the indicator here. And let's go to studies, and we'll just say, just delete the study set on this chart. Or maybe we'll just go to edit studies. There we go. And we'll remove that off there. And you'll notice that basically it's staying pretty much at about 6.3, so we can back out and look at the difference. And, that's pretty much on target right there. We got about a $6 difference on them. So, and it's going to oscillate 10, 20 cents there. And, be aware that that's going to be a difference in the price. So when you're looking at the price, you really want to be aware of the futures price, but also be aware of the difference. So when you're looking at your spreads, you're basing it on the futures price, not the spiders price. But you could use the spiders as a replacement, and it should stay relatively within this range of $1 or so in difference in movement. And that's important because if somebody's looking at this, they're going to be thinking that they're getting a lot better or a lot worse hedge than they are. In reality, they're getting basically the same hedge, with some variance there that's based on the difference in price. So if you have questions about that, let me know. But you can use this on the spiders as well. So now that we understand between the futures and the spiders, we're going to be coming up in our longer segment, and we'll actually focus in on the futures and how many you apply to the futures to hedge using the Nadex spreads right after the commercial break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to tfnn.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of tfnn.com and sign up now.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, welcome back to the Diagnostic Trading Hour here with Darrell Martin. And one thing I just want to point out, if y'all aren't picking up the standard deviation thing, if you haven't got it yet, definitely need to make sure you understand this concept, how it works, watch the archives. I was just going through and just looking again at the standard deviation just for the S&P today, and we're looking at about an 18 to 19 point standard deviation from yesterday's close is what you're looking for. And if we look at yesterday's close, and we go over here and check this out, what you'll be able to see here is that yesterday closed at 43.5. So if we take that and we subtract, basically 18 points from that, then we're going to get 1325.5. And if we go over and we look at the low of today, you'll be able to see that we went down to 1326. So literally the standard deviation said this is about how far you should expect it to move. Now it could drop another deviation if some more news came out that caused that to happen. Okay? But without something really pushing the market further down, that's as far as you should expect it to move. And if you do expect it to move, you could always, basically look at basically another 18 points, another deviation. But that's where you would want to be tightening stops, things like that on your trailing stops where you're taking your profit. Also may be a good reversal point for you to check out and go in on. So if you would have taken advantage of that, and we go over and let's look at, the daily chart and how that worked out, and looking here at 5-minute charts on ES, and we'll back up a little bit, and let's see here, right here this morning, we come in, and we're expecting basically, 18-point move down on the market. And, if we look where we're at right here, the market literally dropped like 17.5 points right there. I mean, it really did come down quite a bit. And literally just with like half a point shy of the standard deviation mark. So you literally could have started really tightening your stops. So definitely would have had a stop here in my trading plan. And I mean, at that point, I'm probably tightening, and probably even looking at a potential, reversal play using if I can get a really good spread at a good price, possible to go the other direction. Also a great point that if you want to sell binaries, you could sell some binaries here, collect some premium on the way back up, because you don't really expect it to move too much lower than this price level. So definitely capture the standard deviations. They're going to help you a lot with your profit management. Nadex helps you with your risk management, but you need help on the profit management side. Sometimes that, once you get your risk management down, once again, Nadex really helps you cover that. Then you need profit management. Standard deviation is the best tool I've found to help me to know when I have really, basically at that point, you have let your profits run, okay? If they run further, that's great, but at that point, you can feel comfortable knowing I've definitely let my profits run if I've used standard deviation that's got to that point, because that's what I should expect. Anything else is just pure gravy, okay? But you can see even today it worked, and we've seen this day after day after day as I've been showing it to you. You got to take advantage of that standard deviation. It's not a magic formula. It's what the options are telling you that the expected move is going forward on the market. So it's one of the few things that truly is a leading indicator because it is current market consensus. So it's not about what has been happening. Anyways, so, all other indicators about what has been happening, and this is statistics. So we have technicals, fundamentals, seasonals, and statistics. This is statistics. Fundamentals told you, hey, things are bad, right? So fundamentals told you things were bad. Technicals told you things were bad. I think just about everybody on the TFNN broadcast show has been telling you, hey, the market's going down. We called that up at the high. We're like, hey, watch out, be careful. If you're in long, you better be, hedging yourself. Don't be hopping in. Seasonally, we mentioned that a lot of people getting this whole July rally idea, and July is not really a big rally. It's the worst of, it is a rally month, but it's the worst of the rally months, meaning it's very short-lived, and, don't get caught up in it. And then just the seasonal cycle looking at last year, and the pump up basically was caused by earnings coming out and having that payroll cycle hit at the same time. So you had seasonals that caused a bit of a pump up, but also the seasonal also told us don't expect it to actually be a true rally. The technicals showed everything being ready to turn over. The fundamentals showed everything being bad, and now we can use the statistics to help us capture our profit. So again, none of those things made us take trades. They made us aware of the heartbeat of the market. And at the end of the day, take your trades based on what you see on the screen. Okay? So don't put all your faith in any of these things, but it really helps you become a well-rounded trader aware of the things that are going on around you, so that way you can make your trades with some reason, some logic as you're doing them. So as I promised in the last segment there, we're going to go in and we're going to look at how do you hedge these things? What do you do to actually hedge your positions using Nadex? And so you're getting in on these trades and, just trying to figure out, what's the best thing that I can do to potentially lower my risk. And so what I'm going to do is I'm going to log in again. If you haven't logged in, if you haven't set one up, just set one up and try it out. And it's free. Okay, you get $25,000 of funny money to play with. And what's sort of funny on this is you're trying to win on the futures or the Forex or ETFs or whatever. You're actually trying to lose on Nadex because it's your hedge, right? You want your hedge to lose so that way, because that means you're making ideally money on the other side. And so if we go over here, when looking at ES and pull this up, and I'm going to pull up indices, bull spreads, and I'm going to pull up the US 500. Now I'm going to go down here and I'm going to look at any one of the available trades that I can do, and I'm going to try to find a spread that's going to line up pretty close with where the market's at. And the risk, first is the ratio. How many do you need to hedge on ES? Well, on ES, you're going to need 5 spreads to hedge 1 futures contract. Okay? So again, that's 5 spreads for 1 futures contract. And, if you're using, say, the spiders, you want to equalize the price out. So if we're looking at, the market right now, so just so I can help out the ETF traders as well, and you'll sort of see how the leverage is quite a bit different here. But if we go to, let's just say 1328 times 50, that's actually the equity value of 1 futures contract that you can trade for like $500, $400, whatever your margin is with your broker. It goes up to about, 4 or 5 grand depending upon the broker. The overnight margin is set, but goes up, higher if you hold it past the close. But 66,400 is the actual value of this futures contract. So if we go over and we look at, let me pull these off for a second, and we're going to go over here and go, okay, well, what are the spiders at? And the spiders are at 133.43. So to get an actual, value there, basically you're going to be looking at 133.43, and really to equalize it, you ought to be looking at about, I want to say it's times 500. Yeah. So you need 500 contracts 500 shares of the spiders to equal one future contract. All right. Now, since if you're using the spiders, you don't have to actually buy 500 equal one if you're wanting to hedge. Okay. So you need you need 5 spreads to hedge one futures contract, but if you wanted to lower that amount down, you could actually, say, well, I'm only going to do 100, okay? So you could actually do 100 shares times, 100. And then over here, you could do 1 spread to hedge, okay? So 1 spread to hedge an ETF, to hedge 100 shares of the spiders, or 5 spreads to hedge 1 futures contract. Now, if you were going to equalize the spiders to a futures contract, you would need 5, basically the position size. But for every 100 spiders, you need 1 Nadex spread. For every 1 futures contract, you need 5 Nadex spreads. And here's the basic logic on that is 1 point in the S&P 500 futures equals, well, $1 move equals $50. Okay? Well, $1 move on the Nadex spread equals $10 because every spread ticks in, every spread's tick, the last decimal, is worth $1. Well, the S&P or the US 500 spreads tick in 0.0, so 0.0, 0.1, 0.2, 0.3. That's $1, $2, $3, $4. So if it moves from 1328.3 to 1328.4, that'll be $1 move. So a $1 move from 1328 to 1329 would be $10. So you need 5 of them for it to equal $50. So you need 5 spreads to equal basically be worth $50 when it moves. If it's making $50 when the future's losing $50, then you're hedging. Okay? On the other side, if the future's making $50, then the spread is losing $50. Okay? So basically they're equalizing each other out. So how does this work as a hedge? Because if one's making 50, one's losing 50, where do you ever make money? All right? Well, you make money when now, remember how the spreads work. I don't know if you recall this from some of the past shows. The spreads stop losing if you're long the spread. If you bought the spread, okay, it'll stop losing when it gets below the floor. All right? So like this spread right here stopped losing this morning when it got below the floor. And so if we pull it up and we look at the chart on it, you'll actually see how this works, okay? So giving it a chance for it to load. If we have to, we may have to hop back over. Yeah, this one's going slow. So let me hop over. I'm going to hop in a different browser. It'll kick me out of that one. And I want to show you literally how it stopped losing, okay? Because it's sort of interesting just to watch it. And you'll see it just balance out right there at that price that we see right now on the screen. Yeah, see it kicked me out, logged in on the other account. Did its job. That's good. Make sure that you know that somebody is. Same thing happens if you log in on your mobile platform. It'll kick you off your computer, and vice versa. Always good, too, to have the mobile platform, because let's say you lose power, lose internet, whatever. You still have your phone, you have 3G, 4G service. You can still hop on and manage your positions. It's pretty cool. Anyway, so hop over here on indices bull spreads. Go to US 500. We're going to check out that we're going to look at the daily, actually. I think that's what we're going to look at. Yeah, got the daily. And we're going to pull up the chart over here. Let's see if this will pull up a little bit faster for us. There we go. It's coming up. And all right. So this morning, right here about 8:30, 9:30 Eastern, okay, spread over here was at, let's see, 1347, okay? Well, now the market's obviously well below 1340. It's down, 1328, whatever. And notice it got down here, and what's the floor of this spread? It is 1340. So since the floor of the spread is 1340, you can see it right there. 1340 is the floor, 1380 is the ceiling. Then what that means is this spread will stop losing money below 1340. So whatever risk you put into the trade, so let's say if you bought it at 1347, that'd be $70 risk or $350 risk on just the spread. Now, you're not going to have that kind of risk when you're actually doing it with the underlying future. We'll talk about that here in a second. But that's the risk on the spread, okay? So If you would have put that trade on right then that's the most you could lose would be $70 per spread. And it stops losing. If it came back up, then it could make money at the end of the day. So when it's at maximum loss, this is an important rule in the hedge. Let's say you take your profit off, like at the standard deviation level, and then you take off your future contract. Well, your spread's at maximum loss. There's no reason to close it, right? So if there's no reason to close it, don't close it out. Also, if it's a losing trade, meaning it's a maximum, not a losing trade, but if it's a maximum loss trade, at the end they won't charge you an exchange fee on the exit. So you won't pay any exit fees. There's no commissions, but there'll be no exchange fee if it's out of the money on the exit. Cool thing is sometimes the market does do some sort of rebound. So if the market actually did rebound, and we've seen some crazy rebounds in the past couple weeks. This week's been pretty solid trend, but if the market does rebound, you could actually end up making money in both directions, but without adding any additional risk. Because again, you've already taken maximum risk on this. You have time to be not really right, but time to allow it to be right, and it could go back up and make money. So it's pretty cool, having the time to be right and make. I love it when I make money in both directions, and that does happen occasionally. It's very fun. It's like, wow, I had no additional risk at all, and I already took money on my future side, and now I got to make money on this side. So now that you understand that we don't lose any additional money on the downside here, then you can learn how to take advantage of that, and you're going to find the one with the closest floors possible. So you could look at this 1340. It's basically the same thing. And if you have the choice between two of them at 1340 and 1340 on the daily, this one's wider, which means it's going to give you a bigger hedge. So look at the ceiling. See, that's 1370. And the ceiling on this one here is 1380. Okay? So that literally means that you have protection up to 1380. So what does that protection cost you? That's the next big question. Okay? What you got to do is you got to look at the same price there. Basically, the market opens what we were looking at, right? So if we go in and we look at what's the approximate price here, we got looking at basically just 1347 across the board, right there at the the close. So we'll just assume we got in like right on the open. So at the close, you could go here and look at this 1347.5 if you wanted the high, but we'll just be fair, try to make it as similar as possible, 1347. All right, we'll go over here now, and we're going to pull up the ES chart, and we'll get 8:30 on this one. This is Central Time. All right, so sorry, Nadex is going to show Eastern Time. I'm in Central Time here in good old Dallas, Fort Worth, Texas, and we'll just look at the close on here, and so what we're going to do is we're going to be selling at 1345.5. All right, so if I sell at 1345.5. And I'm showing you the extreme case, and I do more analysis than this when I'm actually doing the trade, but I want to introduce you to the concept, and we'll build upon this in future shows. But and a lot of times I'll even do 2-hour ones and things like that. But looking at this, so we got 1345.5, and as you recall in the last one, we basically were saying 1347. So we got 1347, right? So we take that, and so what we're doing we're selling here and buying here. Well, if you sell at 1345.5 and you buy at 1347, what is your risk? What did you lose on that trade? Not really lose, but risk. 1.5. So your risk on that's going to be 1.5, $150. So when you come back, I'll show you how much protection you get on the upside for only $150 risk on the contract. All right. Join me on the other side of the commercial break, and we'll wrap this trade up.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, everybody, welcome back to the Diagnostic Trading Hour. When we last left off, we were talking about how to hedge a futures contract. And there's a lot of cool things that you can do to hedge, but one of my favorite ways, I think one of the best ways, is to hedge trading Nadex. And it literally is the favorite trade that I do. It's very low stress, and you really enjoy it, and you know what your risk is. You don't really worry about getting stopped out, because if you get stopped out, you were definitely wrong. And, nothing wrong with being wrong. What's wrong is not admitting it when you are. And so, it really helps you not have to play all those mind games. Should I get out? What should I do? And if you're a futures trader, maybe you just don't want to hop pure Nadex. But this is a way you can combine Nadex in, again, with your original trades. And, what I want to do is show you, what kind of, how can it really help you out on your trades? And, what can it do to help you with your risk management? And so what I was looking at is if we went in and we sold the future this morning right there at the, the open of the market, 1345.5, and we bought the spread at 1347, then our risk is not the risk in the spread. okay? Our risk is the difference between the two. And so our risk would literally be 1.5 points. I don't know, my head was a little bit out there, but the calculation on that actually is $75. So it's a $75 risk on the trade. All right? Well, I don't know. If you trade at all, I mean, that's nothing, okay? That's a 1.5 point. I mean, you're going to have that kind of stop loss even if you're a scalper. All right? So 1.5, I mean, that's just, again, nothing. So if you're looking at that, but how much protection does that give you? Well, the ceiling on this spread was 1380. That means you get a 33 point from where you bought the spread all the way up. It's going to be able to hedge you, okay? So it basically won't be able to hedge you between where you sold the future and bought the spread. That's your 1.5 point risk right there. So that's $75 risk. But it'll hedge you all the way up to 1380, 33 points. That's a $1,650 hedge. That's like having it literally, it's getting a $1,650 stop loss for $75. Okay? If it gets up to 1380, yes, you're going to have to close the trade. But your only risk on the trade, $75. Okay? I don't know if you can see this, but this can totally change how you trade. Massive stop losses for pennies on the dollar, literally. I mean, if you want to do the math, let's see here. I'll probably do it backwards the first time around. But if you want to, I mean, it's 1650 divided by 75. Yeah, I mean, nothing. Okay? So, what are we? For every dollar, okay, that you're putting up right there, you're getting $22 of risk management. All right? And I mean, that literally, I put up $1 and it's going to give me $22 of coverage. So, I mean, that's just insane coverage. And that's if I want the one that goes all the way to the end of the day. Okay, that's buying the 415 one. Okay, 415 expiration spread. I can also go in and I could have done one that expires sooner, like at 9 to 11, because the market usually is pretty much hit its point or come pretty close to that around that time. And once the market has moved into your profit zone, you don't really care about the hedge anymore, because then you're just trailing your stop down. Okay, your risk would be even smaller. So I did a trade a few weeks ago. Literally, my risk on 3 futures contracts was less than $75 combined. Okay, check this out. Watch this video again. Call in with questions. We're going to keep covering this hedge strategy. Make sure you get it down, and we'll apply it. We'll look at looking at the euro dollar on it tomorrow. Okay, so I look forward to everybody calling in, checking out, and listening in. Appreciate y'all being out there, and y'all have a great day, great weekend, great luck in the markets, and we'll talk to you tomorrow.